Despite heightened volatility in Indian equity markets, retail investors' confidence continues to be strong. Data released by the Association of Mutual Funds for the month of March showed a continued rise of SIPs and inflows into the Indian equity market. SIPs, in fact, have crossed the 14,000 crore mark for the first time ever and stand at an all-time high of 14,276 crore rupees. Similarly, equity inflows also crossed the 20,000 crore mark compared to 15,000 crores last year. So what has spurred this growth despite volatile markets? Will it sustain? To speak on this, I'm joined now by S Venkatesh, the CEO of AMFI. Of course, we will also continue the discussion with more voices from the industry. But let me begin with you, Mr. Venkatesh, and welcome you to the show. Thank you for speaking with us. Now, almost 6% increase has been seen in assets under management in 2022, while we saw a marginal decline from the month of Feb. Why is that?
Essentially, it is a factor of market movements. Market was very volatile during the month of March. So naturally, the market has an impact on the NAV and consequently on the AUM.
So it's been a good month for equity mutual funds. They've been the highest in a year. On the other hand, we've seen debt fund outflows also increasing. They're at a 6-month high. Why do you see that disparity? And is the debt outflow because of the tax law changes?
Essentially, the equity inflows have been high for the simple reason 20,000 crore has come in. Net flows have come in into the equity mutual funds. And it is because the investors are taking a view that the Indian markets will do well in this financial year. So they have started investing into the equity mutual funds. As far as the debt mutual funds are concerned, the debt mutual funds are because of the budgetary impact. If you look at the budgetary impact, people are looking at the ways and means of managing the debt funds. In the debt funds, essentially there is an interest rate tightening cycle which had happened, and March being a quarter end and year end month, the corporate treasuries would have withdrawn money from the liquid fund and overnight fund to pay off their taxes, and the banks would have taken money out of the liquid fund and overnight funds to manage their capital adequacy. Because of this, you saw a net outflow of 50,000 crore, over 50,000 crore in the debt funds.
Mr. Venkatesh, meanwhile, we've seen SIPs breaking records, and that's the record set in January this year. What do you put this down to? How do you see investor behavior in the first 2 quarters of FY 23-24?
We see a very positive trend in SIP flows. The last year, if you see, at least around 14,000 crore has been there in the last 4 months, and now if you look at this month onwards, we will still see the 14,000 crores coming up. By the year end, we believe that at least the SIP flows should be at least at around 15,000 crore.
And are small and mid-cap funds getting hotter this summer, in your view?
The small and mid-cap funds are also doing well for the simple reason the small and mid-caps had valuations have corrected substantially. So people are now thinking that there is scope for small and mid-cap funds to perform better. That is where the money is coming into small and mid-cap funds.
You know, some interesting data that has come out this time round, and I think we should focus on that a bit as well. 40 lakh first-time investors, 11 lakh new women investors. The total pie, however, is below 4 crore unique investors. Do you see a rapid change in the way the average Indian is investing and engaging with the stock market?
Definitely, the Indian economy is poised to grow and do better in this financial year and the coming financial years. So essentially, Indian markets will do well. If that is a premise under which we are working, equity market will do well because the corporate earnings are expected to be much better, which will ensure that the valuations will also go up and the equity markets will do substantially better. If that is the case, we will see the equity mutual funds grow in the years to come.
Well, we certainly hope so. Thank you so much for speaking with us. That was the CEO of AMFI, Mr. Venkatesh. Now, to take this further, I'm joined by D P Singh, Deputy MD of SBI Mutual Fund, and Kumar Saurabh, founder of Scientific Advisors. Welcome to both of you, and thank you so much for joining us today. Mr. Singh, let me begin, with your take on what this latest data shows us. Is it also reiterating sort of the depth that we're now seeing in the Indian markets, equity investors coming in at a time, retail investors coming at a time of volatility? Are they finally beginning to buy on dips?
Honestly speaking, if you ask me, I am not very happy with the kind of numbers which have come. The 40 lakhs number is not very, very encouraging. If you look at the overall pie size, see the kind of numbers. Today also we are having less than 4 crores unique investors in mutual funds. If I talk about even only State Bank of India has 45 crore accounts. So 44 crore of number of investors, the numbers have to be much, much more. Though we are looking relatively, it looks good that we have better number than last year. But I think penetration is still very low, and the industry needs to do much, much more than what it has done till now.
It's an interesting way to look at it, that we are growing but not nearly enough. I think also at the context, if you can look at the context right now, Mr. Singh, traditionally equity investors start panicking the moment markets show a little bit of volatility. They start withdrawing their funds or stopping their funds. We've not seen that happening here. Is there a change in the way investors are looking at mutual funds as an opportunity for wealth creation?
Definitely, you see, the investors have evolved, a lot of education has happened. If you look at it, the overall in the whole year, the total SAP trigger amount is almost 1,46,000 crores in equity side. 1,46,000 crores, and the total net flows in the industry is 1,54,000 crores. The whole year money has come as through either SIP or STP. STP is systematic transfer plan, which is added into the SIP numbers only. People are putting money in equity market because of volatility in staggered manner, and that's a very, very healthy sign. That shows the involvement of investors. They are not going whole hog. They are putting money in a staggered manner, and that's the way to go for the investor. But this number of 1,50,000 crore overall, 1,54,000 crore for the year, and 20,000 crore for this month, out of which 14,200 is only the SAP inflows. 6,000 crore of total difference which is there to come in during this month, and that has happened because of 1 or 2 NFOs. Like we had one NFO which collected 3,700 crore rupees, and that data came in March. Other than that, the total inflow is around 2,000 crores for the month of March, other than SIPs. So we have to make little deep dive and look into the numbers. But yes, I congratulate the Indian investors to who are doing it in a very, very structured and very staggered way.
Let me come to you, Mr. Kumar Saurabh, on what this AMFI data is really telling us about investors. And I want you to focus on the debt fund outflows that we've seen. Do you think that's a seasonal thing? It tends to happen in March. And is it an impact of taxation norms that have changed, which will persist?
I think definitely it's more to do with the impact of the taxation which has come. But even from equity side, if you see the current correction which has happened, so partly you can say it is because of the impact of taxation, but at the same time, the 3 months of correction which we went through between January to March, I think that could also be a reason. And it's not like the retail investor has done it only this time. If we look at the whole 2022, that was the year when we had one of the worst FII flows. And the biggest of the FII flows happened in banks. Almost 50% of the FII flows which happened, it was through the banks. And still, the banking sector did well just because the DIA, which is the mutual funds, they kept on buying. So the behavior of the retail has been good, which is reflected to the SIP data throughout the year. And the movement of the debt fund, I believe it's partly due to the whatever came out of the budget, and at the same time, the correction which has happened in equity market.
DP Singh, I'd like your view as well on the debt fund outflows. Do you see that as a persisting problem?
No, I don't think so, because I had looked at the debt numbers on the liquid funds and the other funds separately. The maximum outflow has happened out of the overnight and liquid funds. The longer duration, medium duration fund, they have not seen the outflow. Actually, because of the tax laws, during the last few days, a lot of inflow has come rather than outflow. Had those changes not been there, I think we would have seen a higher outflow number in the last few days. Actually, 30,000 crore new money came into duration funds and the target maturity funds and so on and so forth. I mean, other than that, had it not been there, then I think the month would have seen higher outflow than what is being seen now.
Yeah, that's fair enough. People wanted to lock in that long-term capital gains reprieve that would expire after the 1st of April. So they got that push to put that money in. But the question, though, Mr. Singh, is that now that sort of window has passed, do you see an impact of the tax changes on this category?
No impact on the HNIs and ultra HNIs, definitely it will be there, but still putting money, see, debt fund inflows in the longer duration are always a cyclical thing. At this point of time, when RBI has already pushed the pause button and the interest rates are likely to go down, this is a good time to put in money even now. We are seeing inflows even at this point of time without the tax arbitrage also. Because if the people want to play duration, they have to play through mutual fund only. Whatever capital gains have to come are most likely to come in next 1.5 years. So the old investor will continue to put in money, irrespective of whether the tax laws, when tax arbitrage is there or not. Maybe number will come down because very ultra HNI and the corporate investors, they may shy away because they have other revenues also to invest.
Exactly. Kumar Saurabh, advice for our viewers, for investors, and also a commentary on the fact that index funds continue to be very, very popular. Is that the way to go in your view?
I believe so. And if we look at the markets, basically we talked somewhere around October to December 2021. And since then, it's almost 1.5 years. And the small cap index is down by somewhere between 16-17%. Nifty has been flat. And usually, whenever historically we see we have spent these kind of times, the next few years have been good. Even valuation wise, when we see we have come in the fair value zone, where if we look at Nifty 50 or Nifty 500 or small cap index, from a frothy zone to somewhere where they are somewhere between 18 to 20p, which is decent. Now, talking about index fund, this is a trend, and this is something which is happening in India, but it has happened. If we look at the developed economies also, this is the trend which has happened. If we look at the US data, this is how it peaked, and basically the shift from active managed fund to passive managed fund, the shift from higher to TER to lower TER, these things they have played in US market, and similarly it is happening in the Indian market also. And my view is this will grow further, and we will see more product innovation, we will see more kinds of index funds, we will see more kind of ETF funds coming in market in the future.
Absolutely. Well, good data for now. But as Mr. Singh said, there's a long way to go. There's a lot more scope as far as mutual fund investments are concerned for Indian savers. Thank you so much to both of you for joining us today. And let's take a look at how markets fared. Nifty ended the truncated week in the green for the third week in a row, above the 17,800 levels. The Sensex too gained close to 600 points this week. And although it was beat up yesterday, PSU Banking PAC managed to emerge as the top sectoral gainer, led by Maharashtra Bank. FMCG, Realty, Auto, all were in the green for today. On the other hand, the IT sector was down over 1%. TCS earnings dragging it in trade. Pharma too snapped its 8-session gaining streak. My colleague Anisha is here to share the highlights of today's session.
Well, it was a good week coming in for the bulls because the Nifty continued to advance for third week on a trot, managed to eke out a gain of over 1%, and it was the Bank Nifty that outperformed this week with a gain of 2.5%. And if you're looking at other sectoral indices, it was Realty, which was up over 5%, and then Pharma also managed to do its bit. What was definitely underperforming was IT pack. So we saw the numbers come in by TCS, and that played the spoiled sport because for the week, the IT index was down in the trading session and it managed to snap the 2-week gaining streak, and with the stocks like Persistent and LTI Mindtree losing the maximum. From the broader markets, a few stocks that deserve mention include AU Small Finance Bank as well as Godrej Properties. They were quite excited in the trading week. And then you look at the stock of FACT, which was up as much as 50% in the last 7 days itself. So a massive rally coming in for that one as well. Overall, if you're looking at the other indices, it was autos which was up around 3.6%. We saw good gains come by for Eicher Motors after Goldman Sachs initiated coverage on that one. We also had decent numbers come in from Bajaj Auto with respect to their Triumph dealership plus positive brokerage action coming in there. So overall, a good week coming in for the bulls. We have recovered almost 1,000 points from the 1,600 thereabout lows that we had seen a couple of weeks ago, and a rally of almost 5% on the Nifty over the last couple of weeks. So ahead of the proper earnings season starting in, it's a good show coming in for the bulls.
All right, stay with us, Anisha, because more news coming in on the IT sector. Tech giant Infosys has reported a disappointing set of numbers for the Jan-March quarter with a 3.2% decline in revenue in constant currency terms. Revenue guidance came in at 4 to 7% for FY24. Anisha Jain with us, giving us more details.
Infosys has missed the FY23 guidance with a growth of 15.4% versus the guidance of 16.5% due to the big disappointment coming in on the top line front in the quarter gone by. A constant currency revenue decline of 3.2%. That compares with the street expectation of 0.6% growth, and a growth by TCS which was reported close to that figure as well. So a big disappointment coming in from TCS. As far as the top line is concerned, the management attributed that to one-time impact coming in on account of project cancellations, as well as slower ramp-ups and delayed ramp-ups that we saw in verticals of telecom, high-tech, as well as retail, as well as they are seeing some weakness in mortgage and insurance, the BFSI verticals that they had called out earlier as well, and investment banking too is a bit of a slowdown as well. The FY24 guidance is rather tepid. They're expecting a growth of 4 to 7% only, and that compares with the street estimate of 6 to 8%. Nobody on the street was expecting a lower range of the guidance to be at 4%, so that's the big disappointment. And similarly, disappointment coming in on the margin guidance front as well, which is standing at 20 to 22%. The street was expecting a number of 21 to 23%, so big disappointment coming in there as well. The only silver lining, if at all, is one, that the deal win continues to be steady at $2.1 billion, plus the comment coming in from Salil Parekh talking about that they have the largest pipeline of deals that they have seen in a long time, and also the fact that they're seeing some stabilization in the month of March, but the demand remains uncertain, and that's the reason they're not able to call out when the recovery will happen. They want to keep the guidance a bit tepid to give them the leeway available for any room on the upside, and they are talking about levers available on the margin front as well. But so far, a very disappointing set number coming in from Infosys, and the expectation is that there's going to be an EPS cut coming in of 5 to 10%, and we'll see a sharp decline coming in on the stock price when it opens on Monday.
In Q4, we saw changes in the market environment. During the quarter, we saw unplanned project ramp downs in some of our clients and delays in decision making, which resulted in lower volumes. In addition, we had some one-time revenue impact. While we saw some signs of stabilization in March, the environment remains uncertain. This led to our Q4 year-on-year growth of 8.8% in constant currency and quarter-on-quarter decline of 3.2%. Our operating margin was resilient at 21% for the quarter. We had $2.1 billion in large deals in the quarter.
ET Now's managing editor also spoke to Rajesh Gopinathan, CEO and MD, K. Krithivasan, and CEO designate, and N. Ganpati Subramaniam after TCS came out with their Q4 numbers yesterday. Let's listen in to that conversation.
Our exposure to regional banks is very marginal, and it's not significant. The confidence that we have is also coming from the fact that there is it is not a chain reaction that's happening, right? Unlike the GFC crisis. When something went wrong, there are several banks got impacted. Whereas in the current situation, it seemed to have been isolated to two, one in the US and one in the Europe. And they have been largely contained with a tremendous amount of government support on either side, right? Our government interventions, which were very timely, right? Thirdly, I think, the order book that we have got this quarter, 3.1 billion from financial services, doesn't seem to, correlate to that, right? In the sense that most of them feel that these are projects that need to be executed, right? And it's also a one lumpy deal. We've got at the same time, several small to medium sized deals, which augurs well for our execution on a quick and timely basis. Thirdly, I think we have built the capacity, we have trained the people, and as Rajesh pointed out, the time is ripe for doing some of those operating model interventions in terms of getting down the contingent labor down, right, and improving our own utilization, all of that thing, right. I think these two is what we'll have to do in the short term, right, and continue to look at the pipeline that we have, which is again quite good, quite robust, and convert those pipeline into deals as quickly as we can.
Sanjay, I distinctly remember last time when we met, my question was phrased on the following, thought. Was there a probability or a possibility of a double-digit growth? And you emphasized on the word possibility. So looking at the start of this year, the word possibility of a double-digit growth is completely out.
I think it is a possibility still.
Still a possibility.
I would say it's a possibility, because our exit rate is good, our deal pipeline is good, our order book looks good. Customers feel that let's spend wisely, there is some deferment, no large scale cancellations. When I put all these things together, I think it should augur well for our growth. But then, we have to wait and see what happens in the next 6 to 8 weeks, right? And it's also an election year, in many parts of the world, right? So we'll have to see how these two things play out in the next 1 or 2 months. But if I look at what we have as order book, what we have as pipeline, what we have as capacity, and the challenges on the supply side abated, if I juggle all of these things, the possibility is there.
So, Rajesh, if I connect the dots here, your opening remark, Kriti's confidence that this is going to be a short-lived volatile patch, NGS's comment that there is a possibility of a double-digit growth. Can I say that while it will be difficult for you to pinpoint the accuracy in terms of whether recovery will happen, you are reasonably confident that this is just a small passing phase? This is not like any kind of a structural decline, or you need to revisit your earlier assessments?
Absolutely. Absolutely, we believe so. And it's not just hope. So if you look at it, we are very confident about the ongoing strength in UK. And both our momentum as well as the deal flow that we have seen, UK is on a good wicket. Europe, we hope that it has bottomed out and should start turning. And Europe has been sequentially slowing, so it's been a drag. And even if it flatlines, it will actually start improving the impact from a company perspective. And there is an opportunity for that to start improving. US, as I said, we don't see structural challenges there. We are like, even if a technical recession actually happens, there is enough resilience in that economy. The clients that we see, we don't see many weak clients, and therefore that should also give us. So there the timing issue is there. So it's more of a timing rather than a structural problem, and we are executing on that belief and doing everything that it takes to position us for that.
And HDFC Bank is set to report its Q4 numbers. Harsh joins in with what the street is expecting.
Well, yes, HDFC will kickstart the banking earnings for Q4. We're expecting net interest income to expand a solid 25% on year-on-year basis. 23,500 crore is where that number is expected to come at. A healthy clip with regard to the way in which loans have also grown, 17%. They've disclosed that particular number in their business update. Moving quickly on to operating profit, though operating profit not growing as fast as probably the net interest income, and that's on the back of good OPEX that HDFC continues to push out because of the number of branches that they're opening. 1,400 plus branches in this particular year is what they've already pushed out, and therefore your operating profit will come in 19,500 crores odd, and it'll expand by around 19.5% on a year-on-year basis. We're also expecting provisions to see a bit of an uptick when I'm looking at it sequentially. 3,000 crore is where that will come at versus the 2,800 crore Q3 of FY23. And therefore, we'll see profit after tax also largely in line. 19% higher is where we'll see profit after tax. Around that 12,000 crore mark is where we anticipate to see that. Now, in terms of disclosures, they've already told us deposit growth has been extremely strong, 21%, 1.5 lakh crore of deposits completely mobilized in this particular quarter. What a stellar quarter it's been in terms of that particular metric for HDFC Bank. The other piece, of course, to look out for is one is credit cards. The second is margins. Mind you, where do margins move from here as the deposits start getting mobilized is a key question. And the other piece that also one would have to look out for is how quickly is the merger now going to go through, because that 23 lakh crore book is what we will get to see, I don't know, maybe in Q1 of the next year.
And Indian tax authorities have issued a show cause notice to several foreign companies, including some that have been operating in the country through their subsidiaries for a long time. It's also understood that the companies have been asked to shed light on sources and valuations of their investment in the country, and in some cases passport and travel details have also been sought. The story was broken on the Economic Times, and joining me now is Deepshikha Sekarwar of ET, senior editor at the ET. Thanks Deepshikha for speaking with us. Now, how many foreign companies are facing this IT action and what are their complaints?
Thank you, Tamanna. So multiple companies have been issued. Overall, besides companies, thousands of notices have gone out all over the country. But in case of companies, at least a few hundred notices have gone out. And these have gone out to, headquarters of the companies, the parents based abroad, for their fund infusion into the Indian entities. And what has really come as a surprise is that, these foreign companies are being asked to provide, details of the source of funds that they infused in the entity. And also the valuations which was, undertaken at that time, the valuation of the investment.
The timing is also important, Deepshikha. Any light that you can shed on that, especially at a time when there's so much talk of faceless income tax and the use of technology?
Definitely, Tamanna. The move has really surprised everyone because, there is a concerted effort from the government side to, project India as an alternate investment destination. But what income tax sources have told us is that these notices were based on certain risk parameters which were fed into system, and the data was provided to the field officials who have then, based on that information, issued these show cause notices. These are for assessment year 2019-20. And after satisfactory explanation from these companies, they would be considered for further action or for no action at all, depending on what the response of the companies is in this case.
One interesting part about your exclusive story also was you reporting that such income tax action could dent confidence for foreign investors. Is it about compliance burden or fear of the taxman?
Well, yeah, if a foreign parent receives a notice seeking explanation of the source of funds or the valuation, it does sort of unnerve a lot of investors. But definitely a lot of work is being done in terms of policy, in terms of ease of doing business, in terms of easing compliances for, businesses, which is showing its impact. We've seen FDI over the past few years rise, and the overall sentiment may not get dented so much, but it does create some bit of discomfort, if such actions are taken.
Absolutely. Thank you so much, Deepshikha there, senior editor at the Economic Times, talking about a story that she's broken on the newspaper. Now, the United States reported a slowdown in the inflation print, with consumer inflation yesterday and the producer price index today. The PPI fell by 0.5% on a month-on-month basis, where the street was expecting it to remain unchanged. This may bring some relief to investors as it shows signs of a cool-off in the economy. So let's take a look at how those numbers are playing out on Wall Street. Of course, open in the green. Dow and S&P 500 now trading flattish, marginally in the green. In fact, the Nasdaq was up over 1%. Another factor to watch is the earnings this week, which is bringing some optimism on Wall Street. Delta Airlines has reported an upbeat Q2 guidance, projecting record bookings in the coming summer season. And Lamborghini has launched the Urus S SUV in the country with prices starting at just 4.8 crore rupees ex-showroom. This new SUV is an upgrade from the Urus SUV, the luxury car maker's best-selling model since 2018. This super SUV has already made its global debut in October last year. My colleague Aishwarya took a closer look.
In the world of fast cars and luxury sports utility vehicles, there's a new addition. The Lamborghini has launched its Urus S, which is a facelift version of the Urus Standard, which was launched back in 2018. Now, this car features a 666 horsepower engine. It can get you up to speed to almost 100 km per hour in 3.5 seconds and has a top speed of 305 km per hour. Now on the front you can see this grille, which is a steel grille, unlike the Performante, which has a chrome grille for better performance and lightweight. Also on the top of the bumper, front bumper, you can see these air cooling vents, which are also a standout from the earlier Urus, and sleek design of the headlamps as well as floodlights. Now onto the side we can see, let's have a look at the wheels. Now these wheels have air suspension, unlike the Performante, which has a different sort of suspension, spiral suspension on the side. This, although, is equipped with an air suspension. Onto the side you can see a combination of inserts as well as claddings on the side in black. Out here and near the footboard there's a black cladding as well, which gives it a sharp look on the sides. Now apart from the front, which is a little different, there's also been a tweak or sort of enhancement to the back, the rear bumper as well. If you have a look at it, it's become more muscular as compared to the standard Urus. Now this is all set to hit the roads and will be available for consumers in India very, very soon.
Domestic sales of cars surged 19% in the last fiscal to 17.4 lakh units by March, according to the latest SIAM data. And total sale of passenger vehicles grew by 26% in the same time, which includes utility vehicles and vans. High demand for SUVs, improving chip supply spurred this growth despite inflationary pressures. My colleague Bhavya Dua caught up with Vinod Agarwal, President SIAM, who shares the other factors leading to this growth.
अभी आप करंट इकोनॉमी अगर देखते हैं तो आई डोंट थिंक देयर इज एनीथिंग व्हिच इज गोइंग टू इम्पैक्ट द करंट डिमांड. सो देयरफॉर वी आर वेरी पॉजिटिव दैट दिस डिमांड ग्रोथ शुड कंटिन्यू इवन इन द करंट ईयर.
So apart from the passenger vehicle segment, the export of commercial vehicles, two-wheelers and three-wheelers have gone down. So do we see that because of global recession fears? Do we expect it to go back to its previous levels?
One of the reason is the global situation, and of course the things are not going to remain like that. Things will improve as we move forward, and there are also various other things that we are working out. For example, with some of the countries, if we are able to work on the rupee trade, which government of India is also working on it, and that will help. So like there are some such steps which are being taken that should help. But fundamentally in the medium to long term, based on the very conducive trade policy that has been announced by government of India, hopefully the exports will continue to grow.
What are your views on electric vehicles? Do you think that is going to take up a major market share in the next 5 to 10 years?
Absolutely. Electric vehicles are slowly and steadily they are improving, but still the numbers are very, very small with respect to the total numbers. In passenger cars, we are still at just around 1%, and in the two-wheelers, they are also still around 4.5%. So therefore, as we move forward, it will evolve. We will see more and more electric vehicles on the roads.
JK Cement CEO Madhav Singhania believes that the cement industry growth will be single-digit this year. He also mentioned that the GDP growth and impact of the pre-election year on cement industry will be seen. My colleague Sumita spoke with him.
The outlook for this fiscal year is again, it's pretty good because of the pre-election year. You always have a pretty high government spend on infrastructure as well as housing, and you will see, I mean, as far as cement is concerned, it always has a multiplier impact in terms of government spending on infrastructure, and also it also has it's about 1.2 times GDP growth typically. So given that the GDP numbers look to be around 6-7%, you'd see the cement growth also as a high single-digit number this year.
You know, when you talk about the GDP estimates, the IMF has recently revised India's GDP estimates and it's down to 5.9%. We also had World Bank numbers come out, although they see India as a bright spot. But then, you know, revision of these numbers in a way says that India is not completely insulated from other global macroeconomic headwinds, right? But the fact is that there is a domestic consumption story is still strong. Having said that, what are some of the headwinds that you see for the rest of the year going forward?
You see, the India story is very strong, and it's because of the domestic consumption. I think that is something you just can't take away. And also, as I said again, the pre-election year has a big impact.
But I think my question was particularly related to the headwinds that you see for the sector.
For the cement sector? So as on date, you know, the only possible headwinds is that as an industry, the commodity price increase has not been passed on to the market. So despite demand being strong, the pricing scenario has been pretty weak, which has been reflected in terms of the earnings of most cement companies over the last fiscal year. And we do hope to see some recovery with the commodity prices softening in terms of the earnings of the sector.
It's time for a very small break on the show, but before we get into that break, let's take a look at some of the other top headlines of the day.